Greetings and welcome to Downhole Energy's brief presentation of the market, the media, and the myths surrounding low-priced oil. I'm Kyle Thomason, Head of Education and Project Development, and a paralegal for Downhole Energy and our parent company, Coastal Petroleum. Now, it's a fairly big day for me when I don't get someone sending me a recent news article or YouTube video regarding the oil price plunge of the day, or some news expert pontificating on just how bad it is for oil companies and where it's all headed. So naturally, we at Downhole had to respond. The media drives perception, and there's a huge perception that oil and gas companies cannot make money in times of low-priced oil. This is simply not true. Not true for every company. So why oil? What's good about oil now? For those of you tuning in, I'm sure the concept of buy low, sell high would be at the forefront of your thinking. And you would be correct. This is exactly what we as an oil company are doing. The beauty of which is that we are also able to pass these savings along right down the line, so everyone benefits from a low-priced market. The second reason we're talking about why oil now is something that we're going to go into in great detail about in our full presentation, Introduction to Oil and Gas Investing, and How to Profit in a Low-Priced Oil Market. For those of you who know in your heart of hearts that there is more to this market than simply low prices, I urge you to sign up on our website for the full presentation and education. You will definitely walk away with a new appreciation for oil. And what I can tell you is that quite simply, we can make $45, yes, even $30 oil prices work. Now, what do I mean, make it work? Well, any business isn't in business to not make a profit. Oil companies must engineer their projects so that they have the ability to make money, no matter what the price of oil is. If they cannot do that, they will not survive long. At Downhole, our costs are allowing us to engineer drilling projects that not only allow us to survive, but have the potential to thrive in times of low-priced oil. But for today, to give you some perspective on both the market as a whole and how that relates to what I'm talking about, well, that's best illustrated with the graphs on the next few slides. Now, this is one of my favorite graphs, and a very good illustration of why we're talking about oil right now. This graph shows a 35-year history of where oil prices were each and every time there was a property market crash. That last red dot on the right was 2008, and the oil prices, conversely, were sky high. The last blue dot on the right are oil prices today, and perhaps with a slight bump up just recently. No big surprise, but if our housing market has ever taught us any one thing, it is that what goes up, eventually, inevitably, will come down. So where's our housing market right now? Well, contrary to what many politicians may say, the U.S. housing market is doing quite well. Albeit some markets are better than others, and if you're in the Denver market, you know what I'm talking about. It's absolutely on fire. But nationwide, where are we there? And very quickly, I'm going to back up and say, no, this is not a real estate presentation. It is about oil. But for you to understand what we can do in a $30 or $45 oil market, you need to have perspective. I have to be able to relate this to something that you know. And housing, whether you own a primary residence only or have rentals, most will be able to relate to this in your own marketplace. But as this is about oil and gas as an investment, and whether it's a good or bad time right now, let's take a look at what the best of the real estate markets are doing to compare. This slide ranks the best of the single-family residential growth markets for 2016 all across the United States. This is the best of the housing market from a rental return perspective. This is the buy and hold market. And why am I comparing this with oil and gas? Because oil and gas is a long-term, highly passive cash flow. And housing rentals are assumed to be a passive investment. So what you see here are the top 17 markets and their projected annual gross rental yield. Top on the list is Flint, Michigan, coming in at 15.3%, all the way down to Santa Cruz, California at 4%. So anywhere from 15% to 4% return in 1 year, which are pretty good returns by anyone's standards. But the point of this slide is that while these are very good returns, if you think these numbers represent pure passive cash flow, you might be wrong. That Michigan market is anything but easy. And the California markets towards the bottom of the list require a huge upfront amount of cash to get into them. And if this is the best of the U.S. housing market for rental returns, how well can oil in a low-price market stack up? The answer is much better than you think. which is why getting educated is so important. At Downhole Energy, this is what we're all about. We'll talk to you about the good and the bad, and the not as ugly as you may think. So was the boom a bust? Yes, the media pounds us day in and day out with how bad things are. But since when did oil companies making tons of money ever give good ratings? Profitability has a lot to do with a company's debt holdings. Many oil and gas companies, big and small, took on outside debt when times were good in order to grow production. However, if that company took out a loan when oil prices were at $60, $70 or higher, they still have to make payments back. And do they have the money to do this when oil prices are now 70% less? Most companies do not. And the shedding of jobs, capital expenditures, and yes, bankruptcies are now detailed out for all to see on an hourly basis in the media. How does that song go? Kick 'em when they're up, kick 'em when they're down. Give us dirty laundry. That's news. But is it reality? It is for many. But some companies, like Downhole Energy, have no debt. What then? What does that picture look like? For those companies whose management has had the foresight to have seen this and planned for it, the world is filled with a lot of oysters. And this is where buying low and selling high becomes their reality. Some operators, such as ourselves, are now able to negotiate discounted terms on well leases and existing production as compared to when oil prices were much higher. Think of it like buying a foreclosed property. How good is your cash flow going to be if you picked up a home at extremely low prices? Pretty good. And what if you picked up a lease that had already producing wells on it? But those wells needed some reworking or even the ability to apply new technology to older wells drilled many years ago. How good could those wells be? And what if the people selling them were starving for cash to pay back those loans? That's what the other side of the fence looks like. And above all, remember one thing. We're engineering and creating projects that work in today's market, the extremely low-priced market. Wells that will go on for 20 to 30 years or more. And if or when the price of oil rises in that period of time, how great would profits be then? That, my friends, is how you buy low and sell high and make money in a low-priced market. And whether you prefer low risk or are someone with more investment sophistication that prefers more risk, our company and the education we provide have you covered. As the slide says, the only thing risky about oil and gas is not getting educated. If you'd like to learn more, we invite you to go to oiltoday.com and sign up to listen in to our full presentation. In this, we are going to go into details regarding a segment of the oil and gas industry the media never reports, and one that I can assure you makes great sense in times of low-priced oil. And thank you for joining us.